Today we're going to talk about 5 ways that bad accounting is killing your tax bill. And it's an often overlooked part of tax. The assumption is that we get the financial statements, we do our magic in the software, and produce a return that saves you tax. But it's a missing step. There's a missing step in there where we have to make sure the financials look right, the financials are presented correctly, because on most business tax returns, we also give them a balance sheet in addition to the income statement that produces the net income, the taxable income. And so a lot of times, if you've followed me on Twitter or read this newsletter, you know that the balance sheet can end up biting you in the tax bill. And so today we're going to walk through 5 quick examples if instead of reading it, you'd rather watch it. So these are real life examples I've run across in the last 20 years, and I just want to share it to spread the word. The first one is losing money on real estate owned. And really what I mean by this is tracking your basis. An example, right? We had a client who bought a big plot of land and then would buy these plots of land and build these assets. But when it came down to it, he wouldn't either have the cash in the business or he had the cash in another business. And so he would come out of pocket for the down payment. Well, when he goes to sell, he doesn't tell us that, right? And the accountant doesn't know this. And so he ends up with a larger amount of gain because his basis is lower from the amount of down payment he put on. The down payment never made it into the accounting records as an increase in basis. And so what ends up happening is his gain looks larger. He comes to us and he says, I feel like I'm paying too much tax. This doesn't feel right. Once you adjust for the down payment, the tax doesn't add up. We start asking, what do you mean the down payment? We don't see, right? We don't see that. And so what's important here is that you capture all the activity into the asset, and you do this by pulling all of that activity into the financials, right? Let the financials lead to tax properly. Don't make us ask, okay, what was the down payment? How did you fund it? Where did it go from, right? Tracking basis is a part of your gain, and it can cause a lot of headache down the road. Second one is this capitalization versus expense. So everyone knows 100% bonus is back on the docket, right? So everyone knows whenever you buy an asset or have improvements, there's a really good chance you'll be able to write it off. The trick is that you have to still follow the rules. You have to still capitalize that asset to be able to take 100% bonus depreciation. What you don't want to do is assume that everything is an expense. You just write it off as you go along, expense it, and you worry about nothing. What happens is we end up having to go through the details, recapitalize everything, take a bonus depreciation election on that. And if we miss that, and then later it comes back and you get audited and it comes to find out that that wasn't an allowable deduction and it should have been capitalized and then bonused, we have issues. You can have a mismatch and can actually cause tax headache at that point in time. The next one is missing out on tax credits. So tax credits generally, for businesses, generally rely on money spent. And so these are deductions in your books and expenses in your books that we need insight into. And as a tax preparer, you need to be able to see, all right, this is how much the wages were paid to this group of employees, or this is how much repair or research and development, right? So R&D is a big credit. This is how much R&D cost was spent. This is how much contractors were paid for R&D, right? This is how much other expense was paid for these types of eligible credits. We need to be able to quickly isolate that so we can send it to the people doing the tax credit, or they can find it quickly and calculate your credit fairly quickly. Without that, when everything's just lumped into salaries, you drive up your tax bill, you drive up the cost of the credit because it's a little harder to pull that information out, right? So I talk about the P&L should be a tool. The P&L should work for you. You should be able to look at it and very quickly be able to help kind of make decisions, financial decisions, and kind of get a read for how the business is doing. Same thing. It should help your financial advisor. It should help your tax preparer and your tax advisor. We should be able to look at it and say, oh yeah, R&D, you paid $2 million in R&D. We should talk about a credit and get a bid and get a quote and get for all that. So having that level of detail on the P&L is really helpful instead of just a big lump sum. The other one is then now, the next one is intercompany accounts. So before I get into like how we can have a mismatch here, this is also a hotbed for fraud. So accounting for intercompany accounts is critical to kind of get a rein on fraud. The reason is, so this is one of the biggest fraud cases that I'd find in my time as an audit partner, where one CFO was kind of siphoning money out of the company to his personal account saying that it was being loaned out. And the owner, when we went to go reconcile as a part of the audit the intercompany accounts to that other business that we said the money was going to, come to find out, the owner was like, the CFO of that company said, no, we never took the money from him. The owner would always just look at it and say, okay, it must just be a reconciling variance, and just write it off to distributions. I probably took the money out, right? And so he was very dismissive. He was kind of an aloof owner. What happens here is like $2 million of fraud over 2 or 3 years that he just lost track of, or the owner just didn't care to track down. And so this was a big fraud case. We kind of dodged it. We didn't hit. It didn't hit our firm. We had the rep letters. We had kind of some CYA, but it was a big trigger event of like, man, intercompany accounts are a really big hotbed for fraud when you're not watching them closely. It can also happen accidentally, where if intercompany or two related parties are selling to each other, one may record the income, but if the other doesn't record the expense, you have a mismatch, right? One is picking up more income, the other is not picking up enough expense, or it's coded differently, right? And so you can get these mismatches where kind of I talk about this like global debits and credits isn't making sense. This global balance sheet isn't making sense because you have income over here, you should have expense over here. And when you have that, you can drive up tax problems. You can drive up taxable income more than you should have. And then the last one is then personal versus business expense, right? We have to do a better job of tracking what's personal use, what's business use, especially when we talk about assets, things like for small businesses, things like use of vehicles, right? We want to be really crystal clear on what's a business use, what's personal use. What happens is then if you get audited, the IRS has been known to just throw out whole swaths of deductions, right? Instead of spending the time and saying, all right, well, let's get into the minutia, the IRS has the right to just say, no, it's just non-deductible. You have no records. You have no documentation of it. We don't have to accept any of it, especially these kind of special deductions that are really close and personal. And so the other thing is, I'm not an attorney, obviously, but piercing the corporate veil, personal versus business expense, you need to be really careful for what card is used for what. Accounting helps that kind of keep track of that, what's going in and out of the business as a deduction. So that's it, a quick rundown of the really good ways in which accounting can help your tax bill or hurt it. I hope you enjoyed it.